Hi, Ned Hahn from PRD Whitsunday. This week, the Reserve Bank announced an historic interest rate cut to 0.1% for the official cash rate. Mortgage holders have had some luck with some of the big four banks announcing cuts to some loan types, primarily fixed rates at this stage. I thought I'd go into a little bit more depth on this with information thanks to PRD's chief economist, Dr. Asti. The RBA enacted several monetary policy levers in a bid to provide extra support to the economy as it recovers from the unique recession brought on by COVID. The RBA acknowledges the need to drive down unemployment and thus growing the jobs market and lift inflation to a level that is within the RBA's target band of 2 to 3%. The cash rate cut, if passed on in full by commercial banks, will mean that a person with a $300,000 mortgage would save approximately $23 per month. A lesser mortgage payment means more money for the household budget, and the RBA expects that this will be spent on other items, both retail and services, thus having a multiplier effect on stimulating the economy as a whole. A caveat is that a lower cash rate will mean lower interest payments to savers, particularly those with deposit accounts on variable rates. We have seen a huge influx of self-funded retirees seeking property or other investments as a way of propping up their cash flow. From an economics perspective, traditionally the RBA uses such measures when the economy is on the decline or in trouble. However, we do need to remind ourselves that the current recession is not an economic or financial recession as we traditionally know it. For example, one such as the GFC. The current recession is a byproduct of a global health pandemic which has forced us to restrict movement and thus our business practices. The RBA's monetary policy decisions are best viewed as a preventative measure to increase household income and encourage spending in a bid to prepare us for any further economic downturn, particularly as the return to pre-COVID unemployment rates is not expected until 2022. Will remain high at a little below 8% before returning to around 6%. From a property perspective, we're already seeing a strong recovery in many markets across Australia, with the expectation of further activity now that Melbourne and Victoria is no longer in lockdown and Queensland have partially opened their borders to a large part of New South Wales. Data from the Australian Bureau of Statistics released on Monday the 2nd of November showed between August and September 2020, the number of dwellings approved for construction nationally across Australia increased by 15.4%. In addition to this, the ABS reported new loan commitments showed a 5.9% increase for mortgages in September 2020. No surprises here with the uptake we've seen locally around the grants for home builder as part of the government's economic response. A lot of information for you to digest this week, but I wanted to bring a bit of background on why the RBA puts forth or makes these decisions. There's a bigger perspective around the whole economy. It's not just based on mortgage holders. So that's the info for this week. See you next week.